This is part 1 of chapter 8. I'm going to cover the acquisition of long-term assets. So here are your notes. We can see there are tangible assets. They can be classified as property, plant, and equipment. That's just what you would think. You can see that in your notes. Furniture, machines, etc. Natural resources. You may not have thought of those as assets, but they are. Oil, gas, timber, coal, etc. And then land. We talked about land being a long-term asset, but it will be different in that it has an infinite life, so it doesn't get depreciated. We're not going to cover intangible assets at this point. That will be at a later date. When we acquire the assets, so that's the first thing that happens, and then we're going to use those assets for years and years and years usually, and then we will dispose of them. So there's a lot of counting issues because these assets are around for a very long time. Well, let's start with acquisition. That's what this video is about. Well, what is the cost? How much does it cost to acquire the assets? Well, it's the same accounting principle as we saw with merchandise inventory. All costs to acquire it and get it ready for its intended purpose. So it's the same cost principle that we've seen before. So for buildings, there's typical costs involved in buying a building. The purchase price, sales tax, you may do a title search, you may have attorney's fees, and you may remodel. And for land and equipment, I'll just let you read through those on your own. Those are typical costs involved in acquiring it. And for all of these, right, we're going to debit property, plant, and equipment for every one of these costs. Okay, so let's skip the next page and go to our demo. Now, before we get started, I want to kind of help us think through. Here is the time, this is the timeline. Here's where we're going to acquire the asset, and then we're going to begin using it. So here we're acquiring it. I can't read my writing that well, but okay. And then at this point in time is when we start using it. So when we acquire it, that process of acquiring it, we will capitalize all of those costs. By that, I mean we're going to record those costs as going into the asset account. Once we're using it, typically those costs are expensed, and we will expense those. So let's go through and identify in this problem which costs will be capitalized and which costs are we going to expense. So let's go through this illustration. So here we have a logging company bought a saw. It has a list price of $160. So that's our acquisition cost, right? $160,000. Got that comment in there a little early. So $160,000. We're going to get a 5% discount for paying cash, so we get a reduction of 5%. So let's see, 160,000 at 5%. 160,000 times 5%, that's going to be $8,000. So we will get a reduction of $8,000 from that. Then we're going to pay shipping costs. So shipping was $3,200. So that is the cost of acquiring, right? And we saw even with merchandise inventory, if we paid shipping, then that was a cost of capitalizing that. So we're still right here. We're still acquiring this asset. These are costs as part of acquiring. Now, here we're going to hire somebody to operate the saw because we need to have a special platform to mount the saw. The cost of the platform is $2,500. This is part of the cost of getting this saw acquired and getting it ready for use. So we are going to capitalize the cost of the platform, and that is $2,500. Now, the saw operator, we pay that person $50,000 a year. That's over here. After we start using the saw, then that person starts working and we pay them. So we will have salary expense for that person of $50,000. And also, we're going to have theft insurance of $1,800. And again, that's over here once we're using it, the insurance of breaking that out. Okay, so let's add up the cost we're going to capitalize. 160 minus 8 plus 3,200 plus 2,500 is a total cost of $157,700. Now, they also want us to make the journal entries. So, we're going to have the first journal entry just for the purchase. So I'm going to put P down here for the purchase. I'm going to net that together. So let's debit equipment. Right, that's an asset going up for $152,000. And again, we're just going to assume cash is paid out. That's an asset going down, so we credit it, $152,000. Now, if we were being asked about the cash flow, this is cash going out for a long-term asset. That's an investing activity. Then we have the shipping. I'm just going to do S for shipping. And here again, we would debit equipment. It's an asset going up. And that was $3,200. And assuming a cash is paid out, $3,200. So we debit equipment, credit cash, all for the payment of the shipping. This is cash going out for the long-term asset. That is a negative cash flow that is investing. Lastly is the platform. I'll just put other costs for the platform. And we capitalize that in the equipment account. Capitalized means we record it as an asset. So equipment goes up, cash goes out. And that was for $2,500. And again, that is cash out for a long-term asset. That is all investing. So when it's all said and done, let's look at our equipment account. We will have posted $152,000. Then we would have another debit of $3,200. And then the last debit of $2,500. So it is going to have a balance of $157,700 will be the balance in that account. Okay, so that is different kinds of costs. Do I capitalize or expense them? I've got one other application I want the class to see. And this is when there is a basket purchase. So let's look at this particular purchase. This is where they're buying building and land for $1 amount. They're paying $700,000. And let's look at their appraised value. So let's schedule that out. Appraised values. And let's see, there is land and then the building. So land, and I'm just going to abbreviate building at BLDG for building. So the land has appraised value of $320,000, and the building has an appraised value of $480,000. So if we add that together, so when we add those up, total that up, we will get $800,000. Now here's the dilemma. We only paid cash of $700,000. Even though combining these assets, if we bought them individually, we would have paid $800,000. So the question is, I can't record the assets totaling $800,000 because we only paid $700,000. I'm not going to write them above their actual cost. So we have to allocate the cost based on their appraised values. So we're going to figure out what percentage of the appraised value. So $320,000 out of $800,000 is 40%. So the land is going to get 40% of the cost. The building, 480 divided by 800,000 is 60%. Of course, those will add up to 100%, right? So 40 and 60%. Okay, and then all we do is take that times the purchase price, which was $700,000, and I get the allocated cost. All right, so 40% of $700,000 is $280,000, and 60% of $700,000 is $420,000. Add up my allocated cost, there's our $700,000. So let's go see what that's going to look like. So cash is going to go out $700,000. And we're going to, then put that in the land and the building. $280,000 will go into land, and then $420,000 will go into the building. Need an equal sign. Nothing happens on the other side of the accounting equation. Right? I have plus $700,000 here, minus $700,000. Now, cash went out, so we're going to show $700,000 going out on the cash flow statement. That was for long-term assets. That's an investing activity. And then lastly, your journal entry for this, right? Land will go up for the $280,000. The building will go up with the debit, $420,000. And then lastly, cash gets paid out, so we credit it $700,000. And there's our journal entry.